In the first video on this topic, I showed you how to calculate depreciation for Dawson Enterprises using the straight line depreciation method. In this video, I'll show you how to calculate the depreciation if we're using the reducing balance method with the same information. So for Dawson Enterprises, you'll remember they purchased the machine for $22,000. They expected that to yield them a future economic benefit for 4 years, and there was a salvage value at the end of that time of $2,000. When we use reducing balance depreciation, we're not actually concerned about the salvage value. In fact, what we're hoping is that if we've got the right percentage depreciation, the figure that we end up with still sitting in our asset account will be very close to that salvage value amount. So it all revolves around the accuracy of that depreciation rate. In this particular case, the depreciation rate is 45%. And when you're using reducing balance depreciation, remember the first thing that you need to do in that very first year, so for us it's 2005, and I'm going to assume for our purposes here that the year will end on the 31st of December. So we're going to calculate a full year's depreciation. In that very first year, we need to use the original cost price, so that's $22,000, and we multiply that by the rate, which is 45%. In future years, after we've been charging depreciation and therefore we have accumulated depreciation, the actual formula is to multiply the written down value at the end of the year by the rate, in this case 45%. In the first year, as yet, we haven't charged any depreciation, so the written down value is in fact the cost price. So let's do that. We're going to put in 22,000 and we'll multiply that by 45%, which is the same as 0.45, and that will give us an amount of $9,900. The $9,900 in this particular year is the depreciation expense. For this year, it's all the depreciation we've charged through the life of the asset, so that also is $9,900. The written down value we need to calculate, and written down value in any year is going to be equal to the cost price less accumulated depreciation so far, and at this stage that's 9,900, which gives us a written down value at the end of year one of $12,100. Okay, in the second year, which is 2006, the actual formula for calculating depreciation expense is going to be written down value multiplied by the rate. So written down value we know is $12,100 so far, multiplied by the rate of 45%. And I've calculated this already just to save us some time. That will give us an amount of $5,445. So in year two, the year ending 31st of December 2006, we will debit depreciation expense $5,445 and we'll credit accumulated depreciation $5,445. So accumulated depreciation, if we looked at that account, is now going to be a total of 9,900 and 5,445, which is equal to $15,345. That would be the balance of that account at the end of year 2. The written down value is now going to be the original cost price of $22,000 less accumulated depreciation so far, which we now know is $15,345, and that is equal to $6,655. So that's it for year 2. Year 3 is 2007, and in this year, once again, we take the written down value, which is $6,665, and we multiply that amount by the rate of 45%. And because I've calculated this earlier, we know that that's going to be $2,994.75. So in 2007 we will debit depreciation expense $2,994.75 and credit accumulated depreciation by that amount. Our accumulated depreciation we know was an amount of $15,345. We're now going to add to that the latest depreciation amount, which is $2,994.75, and that is going to give us an amount of we're about to find out, plus 2,994 that gives us an amount of $18,339.75 as the balance of accumulated depreciation at the end of year 3. To work out the written down value then, take the cost price, $22,000, and deduct accumulated depreciation so far, which is $18,339.75. And we arrive at an amount of $3,660.25 at the end of year 3. The fourth year is year 2008. In this year now, we need to take the written down value from the previous year, which is $3,660.25, and multiply that by the rate of 45%. When we do that, we're going to get $1,647, and we'll round it off to 0.10. So that's our depreciation expense. If we now add that to the accumulated depreciation so far, the figure that we get is $19,986.86. So that's accumulated depreciation at the end of year 4, and our final written down value is going to be the difference between that figure and the original cost price, and that gives us $2,013.14. Now what we notice about that, $2,013.14 is very close to the estimate of salvage value. If we now sold our machine for $2,000, we would make a profit of $13.14 because it still would have that value in our books.